Welcome to the CondoVulturesTV podcast with your host, Peter Zalewski, a Miami real estate broker, Wall Street consultant, and expert witness. This podcast is focused on identifying real estate buying opportunities in the South Florida condo market of Miami-Dade, Broward, and Palm Beach counties. The CondoVulturesTV podcast is not authorized by the South Florida real estate industry and will most likely annoy many of the region's talking heads. This podcast will feature straight talk and salty language that could be offensive to some. Please remember that past investment success does not determine future gains, especially in South Florida's volatile condo market. For more information, please visit CondoVultures.com.
Welcome to the Miami Reporters Roundtable. I'm your host, Peter Zalewski from Condo Vultures. You are tuning into the Miami Reporters Roundtable, where I bring together current and former journalists, talk about some of the biggest stories that have occurred within the last week. I handpick stories, I send them off to journalists, ask them to give them a read, and basically report back as to what they really think is going on. The objective of the podcast is try to cut through some of the fluff, some of the hyperbole, which dominates the real estate industry, and help you, the audience, understand what might really be going on, what's kind of behind the scenes, if you will. So I have three panelists, plus myself. I was a journalist for 13 years. Each of the journalists I'm going to introduce you to, they've been journalists for 2+ decades or so. But before I go ahead and introduce any of them, let me lay out the rules of engagement. Point number one, if you have any comments or any questions for us, you disagree, you agree, feel free to send an email to inquiry@CondoVultures.com, inquiry@CondoVultures.com. Point number two, if you're listening to this podcast on a traditional platform and you would rather watch it, you can go to any platform that provides for video, and there you will see the video capabilities we have. You can also go to YouTube, where our handle is CondoVulturesTV. So that being said, let me go ahead and introduce you to all of our journalists. The first journalist I'm going to introduce you to, he was a journalist for 25 years, wrote about banking, wrote about finance, wrote about real estate. Right now he has a public relations and marketing firm called Gruss Communications. That's John Gruss. What's going on, John?
Hey, Peter. Glad I didn't have to swim to your office today.
It's been pissing down rain a lot. It's pissing down more than we normally have this time of year. Hopefully it's not foreshadowing for how, what summer's going to be like. So we'll have to see. Our second journalist who's joining us this week is another one of our regulars. He was a journalist for 20+ years, wrote about white collar crime, also wrote about business, and did restaurant reviews. That's no one else but John Fakler. What's going on, Mr. Fakler?
How you doing, Peter? Glad to be back to the Unauthorized podcast.
We're glad to have you back. And let me remind the audience, if you're a regular listener, Mr. Fakler 4 weeks ago came out and announced that his New York Jets, which are a big rival of the Miami Dolphins, we're recording this podcast in Miami, where most people are Dolphin fans, except for some of the sellouts like Mr. Fakler. Well, anyways, a month ago, Mr. Fakler came on the podcast wearing a New York Jets hat, proclaiming that soon-to-be Hall of Fame quarterback Aaron Rodgers was coming to the New York Jets. And thus far, I'm not sure if that deal has gone down. Mr. Fakler, is Aaron Rodgers a New York Jet yet?
Peter, as you're well aware, the deal has not transpired. However, I am wearing my Jets regalia. I went to Winn-Dixie the other day. I got a lot of dirty looks.
Well earned, may I say. And then
Absolutely.
Our visiting journalist this week is a gentleman who's been a journalist for 30+ years. Right now, he works over at Bankrate, where he is a mortgage writer. His name is Jeff Ostrowski. What's going on, Mr. Ostrowski?
I'm baffled as to where Fakler found a Winn-Dixie. I thought they'd all closed, but I guess there are a few still left.
We got them in Miami.
I know the one in South Miami just closed.
Oh, did it?
Or well, at least it has a closing soon sign out front.
Wow. No, we got them over here. We got a couple. I was trying to get some deals, and I got a lot of bad looks. I don't think I'll be wearing the Jets regalia for a while.
Fantastic. So we're going to go ahead. We're going to take a commercial break. Other side of the break, we're going to come back and get into our first three stories.
It's a simple formula, and it works. Buy low, sell high. We're Condo Vultures, and when it comes to your real estate, we help you buy low. At Condo Vultures, we represent the buyer, and now's the time to buy. Log on to CondoVultures.com for more information. CondoVultures.com. And remember, before you sell high, you have to buy low. Featured in the New York Times, Wall Street Journal, 60 Minutes, and Time Magazine. Condo Vultures Realty, a licensed Florida real estate brokerage capitalizing on the condo correction since 2006.
Welcome back to the Reporters Roundtable. I'm your host, Peter Zalewski from Condo Vultures. We're going to get into our first three stories. These are stories that I handpicked. I sent them off to the journalists and I asked them to give them a read. And now I want to discuss the stories with the journalists, and I want them to cut through the fluff and give you, the audience, some perspective of what's sort of really going on. So, John, we're going to start off with you with story number one. This is actually going to come out of Bloomberg. Let me read you the headline. I'll read you the first couple graphs, and I'll ask you to sort of comment. Headline: U.S. home prices seen rebounding after an expected $1 trillion plunge this year. First couple graphs. U.S. residential real estate may lose close to $1 trillion in value this year, but that loss will be transient as home prices are expected to rebound, according to a new poll. Respondents expect prices to fall 2% nationally this year, which implies that the value of the U.S. housing market will fall to $46.9 trillion from $47.9 trillion at the end of 2022, per results of the poll conducted by the housing analytics firm Pulsonomics. John, what do you make of the fact? Are we going to lose $1 trillion in valuations, or are we going to lose possibly even more based on high interest rates, based on some of the skepticism and bearishness out there in the marketplace? What's your read of this story?
Well, I mean, I wouldn't put a lot of faith in some of these surveys and forecasts. I mean, it's funny because I remember just prior to the last housing downturn, I mean, the forecasters completely missed it, and I think that you really have to take these with a grain of salt. And all it tells us really is sort of what the group think is on housing prices, but it doesn't really help with any kind of, I wouldn't bet any money on it. In fact, we have a story further down our list this evening that predicts home prices will fall another 9%. So, I mean, who knows? Who knows?
That's a great point. I know what I'm telling some of the people who reach out to me. I'm telling them, go back to 2019 pricing, take a look at your property taxes, whatever it was in 2019. That's probably more realistic of what you should be looking at. And then if there's a pullback from there, take 10 to 20% off 2019. But any of the realtors out there who are listening, pushing back, feel free to send a comment. You can send an email to inquiry@CondoVultures.com. So story number two, let's
Peter,
go to Jeff Ostrowski.
Can I just jump in on that story for a
Yes,
second?
Jeff, please.
So plunge and $1 trillion sounds like a lot, but really that story is only talking about a 2% decline in home values, which is not that much. Especially after that huge run up we saw during the pandemic boom and then in the previous 8 years before that. So yeah, I mean, it sounds like a scary number, but if you look closer, they're really just describing what's already happened. I mean, it's yes, home prices have pulled back nationally, not here in South Florida, but nationally they've pulled back, and probably $1 trillion, but that's out of 47 trillion. That's really not that big a deal.
That's a great point. Absolutely great point. Jeff, let's stick with you with story number two. This is a story that you actually wrote. I'm going to read you the headline. I'll read you the first couple graphs. You wrote the story, so you might not feel comfortable commenting, but maybe you can give us some insight, some background, help the audience sort of understand kind of what's behind the scenes. So this is coming out of the Commercial Observer. Headline: a flood of defaults swamps big names and big properties, especially offices. Subhead: once one big owner did it, it gave cover for the other institutions to do the same. Now, here's the first couple graphs. The first rumblings bubbled up in the depth of winter. Brookfield, the largest office owner in downtown Los Angeles, defaulted in mid-February on two major properties worth a combined $784 million. Within days, the default started coming fast and furious by some of the most respected and well-capitalized names in commercial real estate, including Blackstone and Columbia Property Trust. Jeff, that sounds like a big number. That sounds like it might be an inflection point. What can you tell us about the story? What can you tell us in terms of what people were saying?
Yeah, so obviously the pandemic really just changed how people work, how they use offices. It's changed demand for office space, and these defaults are just a reflection of that. So people are working from home, and so companies just don't need as much office space as they did before the pandemic. The thing that really jumped out at me, though, is from a South Florida perspective is, all these defaults are happening in places like New York and DC and LA. And it really hasn't happened yet in South Florida. In fact, I mean, we've got new properties like 830 Brickell that's leasing out space for $100 a square foot plus. And so at least here in Miami and in South Florida, we're seeing an influx of companies. We're seeing an influx of people. And so I had an interesting conversation with Terry Blanca, the Miami office broker, and I asked her about that, and she said, "Well, unlike those other markets, Miami has companies coming in. So even if the companies that were here, before and during the pandemic are downsizing, there are enough companies coming in to pick up the slack. So it's kind of a geographic distinction. So yes, in many downtowns where people are leaving, the office landlords are struggling. It doesn't seem to be the same intensity of issues here."
I always have CNBC on in the background, Jeff, during the day. One of the things they're always talking about is you have a lot of people coming in the office Tuesday through Thursday, some of them on Monday. Nobody's in on Friday. And as a result, if you look at the restaurants in the surrounding businesses, many of them are struggling simply because they don't have the same value to justify the retail rent. As you were reporting out these stories, did you see or hear anything related to retail space?
Yeah, that's been a big challenge. I mean, the dry cleaners, I don't know if anybody even uses dry cleaners anymore, but dry cleaners in restaurants and bars, all those places that sort of lived off the commuter traffic that have really been struggling. So it's going to take a while for that to shake out. But one interesting thing is that a lot of cities are trying to bring more residential development downtown. I mean, certainly that's happened in downtown Miami. It's happening in downtown West Palm Beach, downtown Fort Lauderdale. And the price per square foot on residential is actually higher than office. So, I mean, it's possible that cities will replace those office tenants with more, year-round, weekends, residents people who are going to be there and going to those restaurants. I mean, I don't know if it's going to happen quickly enough to save the restaurant or the dry cleaner who's going out of business now. But I mean, it seems like downtowns are really being reshaped right now.
Yeah, it really seems like that. And later on in the podcast, I'm going to ask everybody for words of advice or words of wisdom. And I'm going to reference how I think we can repurpose some of that ground floor retail space in the first few floors in some of these buildings, because there might just be a real demand as it pertains to students and kids going to school. So I'll bring it up later on in the podcast. Now for story number 3, let's go to John Fakler. John, this is a story coming out of the Miami Herald. Let me read you the headline. I'll read you the first couple graphs, and then I'm going to ask you to comment. Here's first couple graphs. Headline: Miami nice? ? Not even close. It's the least neighborly city in America, according to a new survey. First couple graphs, Mr. Fakler. Ringo Starr is saying, "I get by with a little help from my friends," but he never lived in Miami. Mr. Rogers saying, "I've always wanted to have a neighbor just like you." He never lived in Miami either. If Ringo and Fred did live in Miami, they probably would not have had a lot of friends and neighbors to sing along with. And that's according to Miamians themselves, who were honest on a national survey when asked about the lack of kindness in their city. Miami is hot, right? But it's downright chilly when it comes to interpersonal relations, says a semi-annual survey that measures voluntary and civil life in the United States conducted by the AmeriCorps and the U.S. Census Bureau. Mr. Fakler, what do you make of the fact that Miami is hot? It's exciting. It's a place for people to go, but people apparently, they don't care about giving back to the community, and they're not necessarily that nice. What would you say to that?
Well, since for someone who's lived in all 3 Tri-County, Palm Beach, Broward, and last 5 to 6 years here in Miami, I could tell you that is dead on, because this is a city. It's a city not for old men. I'll tell you that. Maybe it was once, but now everybody's rude. People cut you off. I mean, the other day, some guy cut me off and I called him a mook. I haven't called anybody a mook since I lived in New York. I mean, you really have to, everybody has a gun, so you got to be careful. But everybody's rude in the supermarket. There's people cut each other in line. I was like, Jesus, I don't even remember this being like this in New York when I lived there, So this is, you got to be used to that. Now, there's a lot of upsides to Miami, of course. There's shopping. There's all kinds of entertainment, things to do. They got the weather. I mean, the upside negates the downside, no doubt about it. But I agree with if they say that Miami's the rudest in the entire country. I absolutely agree.
Mr. Fakler, but the survey was based on people contributing back to the community and volunteering. Can I ask,
Yeah.
do you do any volunteering?
No, I haven't done any volunteering lately, but I could actually see that point. I don't see a lot of people volunteering here. Mostly people are out for themselves, for what they can get for the community, perhaps. You see that a lot, but it's usually people driving too fast on the streets, blowing stop signs, and trying to get the city government to pass ordinances. It's usually in their best self-interest rather than for the greater community at large.
And just to clarify, what's the definition of a mook? That's not a term that I'm familiar with.
It's a semi curse that we used in New York. If you don't like somebody, you call them a mook. So,
Got it. Okay.
Of course, you need a translation down here. They wouldn't know what it is either.
Got it. Okay. Well, that's not very neighborly of you to be calling somebody that word,
No.
but we'll let it pass.
Well, yeah, I'm trying to watch my temper. I'm not a young man anymore. I mean, somebody could take me out at the knees. I'll go right down. I mean, it's anyway.
That being said, let's go ahead. We'll take a commercial break. Other side of the break, we're getting to 3 more articles. This is Peter Zalewski of the CondoVultures Podcast. I hope you're enjoying the podcast. And I wanted to alert you that if you have a property that you're looking to sell in the Tri-County, South Florida area, I would encourage you to reach out to Jenny Cortez, a licensed real estate broker with CVRrealty.com. She's my partner. She's been in the business for north of 15 years. More importantly, she knows the market. She knows how to get a deal done. And she also realizes that it's more important to get a price that you can accept and sell the property rather than to hold firm on some price that's never going to be achieved and ultimately languish on the market. So if you're looking to do a deal that you want a skilled expert who can help you sell a property, reach out to Jenny Cortez at 305-865-5859, 305-865-5859, or visit her website, CVRrealty.com. Welcome back to the Miami Reporters Roundtable. I'm your host, Peter Zalewski. We're going to get into the next 3 stories that I handpicked. Ask journalists to read and give us their insight into it. John, let's go ahead and we'll go to you on this first story. This is coming from the Insider website. Headline: housing is so unaffordable that banks are losing money for each mortgage they finance for the first time ever. First couple graphs, with the Insider, they go with key points. So let me read you the 3 key points, and then John will ask you to comment. Point number 1, housing is so unaffordable, banks lost money for each mortgage they financed in 2022, a report found. Point number 2, some providers averaged a $301 loss per loan, first recorded by a Mortgage Bankers Association. Point number 3, it's attributed that largely to be the increased cost of financing a loan and decreased housing demand. John, why would you go into a business to lose money unless you were like a journalist?
Well, the business came to a screeching halt when people stopped refinancing as interest rates rose. And I think banks and lenders got caught flat-footed and couldn't cut their costs fast enough, it seems. They couldn't reduce headcounts or office space fast enough and lower their expenses fast enough to keep up with the drop in loan demand, mostly the refinancing in 2022, which that was the big story, I think. So it looks like they just couldn't keep up with the drop, and that's what accounted for the kinds of losses that they're facing now. And then, of course, as interest rates kept rising and home sales slowed, that only aggravated everything. I'm sure Jeff knows a little bit more about that since he's a mortgage reporter.
Yeah, John, your analysis is right on. And I look at those numbers myself. They come from the Mortgage Bankers Association. And so a year or 2 ago, when we were in the refi boom, the mortgage originators were experiencing record high profits. I can't remember the precise numbers, but I mean, it was thousands of dollars profit per loan. And yeah, it's just a matter of they've got this, fixed costs. They've been cutting, they've been laying people off, but they hired up so much to meet the demand and they haven't been able to cut quickly enough. And so they're they just have so many fewer loans to divide across a, a large number of, or a large amount of fixed costs. And I think that's really the profitability issue right now.
Interesting. So Jeff, are you saying that we should probably watch for layoffs as it pertains to mortgage lending?
Well, they've already been laying off. Yeah, I mean, there's been a lot of contraction in the mortgage industry over the past 6 months. And it's it's the same old story. During the boom, it seemed like things weren't ever going to end, and that when it did end, it would be the sort of a gradual rise in interest rates that would shut things down. But instead, we got the sharpest spike in interest rates we'd seen in decades, and that just really it really brought the refi market to a halt, and also slowed purchase activity as well.
Interesting. Now, Jeff, we're going to stick with you with story number 5. This is a piece you wrote. It appeared in Bankrate. And the reason I wanted to go with this story is I think there's a lot of confusion by borrowers out there, or maybe people who own homes and maybe they want to refinance, as to how do you decipher and differentiate one lender from another? Is it based on social media, which is what we discussed last week for a story about an Instagram realtor? How do you actually pick a realtor? But when it comes to lending, how do you figure out? I mean, do you stick where you're banking? So I wonder if we could get, let me read the headline and read the first couple graphs. And I want to get your input, but I'm just wondering if you can also give the audience like a rule of thumb or some way to think about how they should go about considering maybe where they apply to get a mortgage, whether it's new money or whether it's a refinance. So headline, largest 10 mortgage lenders in the United States. First couple graphs, mortgage rates soared in 2022 and loan volumes plummeted. That reality sparked a shakeup in the roster of the biggest and most active mortgage lenders. Rocket Mortgage and United Shores Financial remained first and second by volume of loans originated in 2022. Their positions unchanged in recent years. However, Rocket lost ground to the number 2 player, and other names in the top 10 changed. While Loan Depot remained in third place, Freedom Mortgage, Caliber Homes, Home Point Financial, and Penny Mac Loan Services fell out of the top 10. They were replaced by traditional banks, a reversal from last year when non-bank lenders were growing aggressively and financial institutions focused elsewhere. Jeff, give us a lay of the land. How should people look at the financing world, whether they are looking for a mortgage or whether they're looking to refinance maybe one of their properties?
Yeah, that's a great question, and it's hard to It's hard to answer because I have to admit I don't quite understand every single detail that I'm looking at a mortgage myself. I mean, it's so complicated. There's so many things to consider. It's not just the rate, but the APR, any kind of fees and closing costs. So it's difficult for a consumer, even a reasonably educated consumer, to make sense of it. The rule of thumb is just make sure you shop around. I know Freddie Mac, the big mortgage company, came out with some research recently showing that last year, especially the rewards for shopping around really accelerated. They found that a volatile market where rates were going up quickly, the bids that borrowers were getting were all over the place. Normally it might be a quarter point spread between the 3 or 4 different offers you're looking at. They were finding half point margins last year. So yeah, just shop around, look at rate, but look at not just rate, look at fees and closing costs. But I think the real key is just to make sure you've got at least 3 offers and from a variety of types of lenders. So, the non-bank lenders that you see on TV, you go to your bank or your credit union, maybe to a mortgage broker as well. And just make sure you have a number of options to look at.
Got it. And Jeff, if I can ask you one follow-up question, given the fact you're a mortgage reporter over at Bankrate, and this is something that you really focus on, is there a rule of thumb that maybe the audience can, and realtors as well, can pay attention to in terms of what index or what interest rate should they be following to sort of get an idea of where mortgage rates are? Do they base it off the Federal Reserve rate? Do they base it off of treasuries? They base it off of bonds? Can you make it real simple so people kind of get an idea where what they can expect an interest rate for somebody with middle of the road credit or premium credit?
Mm-hmm. Yeah, so the Fed does not directly control mortgage rates, although it does influence the direction of rates. So the most pertinent number is the 10-year Treasury yield, and so that's the benchmark for 30-year mortgage rates. The 10-year Treasury yield. But even that has gotten kind of unpredictable here over the past few years. Normally the 30-year mortgage rate is going to be about 150 to 200 basis points above the 10-year treasury yield. So if the 10-year treasury is at 4%, the 30-year fix should be 5.5 to 6%. But those spreads in the mortgage industry, that's called the spread. Those spreads have widened just because there's so much uncertainty. Rates have been bouncing around, volumes have been bouncing around. Lenders are getting skittish. Mortgage investors are getting skittish, and so even that spread has gotten wider. So it was up close to 300 basis points or 3 percentage points for a while. So it's a hard market to make sense of right now. Everyone's sort of hoping that spreads will come back to normal, and if we get back to a 2 percentage point spread between the 10-year treasury and the 30-year fixed, then that might take another quarter point to a half point off your mortgage rate. But yeah, that's generally in more docile times, the 10-year yield is the thing to look at. And right now it's, you still look at it, but it's not the same guide that it usually is.
Absolutely. Wow, that's great insight. Thank you for that. I'm sure the audience will appreciate as well. Some realtors are trying to do some deals in this time when interest rates seem to be very high compared to where we were a year ago. Mr. Fakler, we're going to go to you with story number 6. This story is coming out of The Real Deal. I'll read the headline. I'll read the first couple graphs, and then I want you to comment. Headline: Dolce & Gabbana to brand Michael Stern's condo tower in Miami. Subhead: Italian fashion house also plans projects in Spain and the Maldives. Here's the first couple graphs from Mr. Fakler, and then if you can comment. Dolce & Gabbana is partnering with developer Michael Stern to brand a new condo tower in Miami. The Italian designer is the latest fashion house to work with a developer on branded condos in South Florida as it expands into real estate worldwide. Dolce & Gabbana announced this week it planned 2 residential developments, including one in Miami with Stern's JDS Development Group and one in Marbella, Spain with Sierra Blanca Estates. It also plans a hotel in the Maldives. Mr. Fakler, what do you make of the fact that you need to bring in a high-end brand, fashion brand, in order to sell a condo at a premium price? Is this just part of the evolution of condo sales in South Florida? Or does it suggest that maybe so many of these condos are virtually the same? The only way you can differentiate it was to get some sort of branding on it.
Yeah, I think the branding angle is really interesting here. This is a trend that's been going on for a while in Miami. This week we've got Desert partnering up or related for Rosewood Residences, which is sort of named after the resort, the Rosewood Resort up in Hillsborough Beach. But, you've already had Porsche Design, Armani Casa, Aston Martin, Missoni, Ritz-Carlton. They've all got towers in Miami-Dade. So, this is an ongoing thing. Let's be honest. Internationally, Miami is viewed as the sexy city. Even Putin had something to say about his oligarchs, hanging around Miami and buying their yachts and flitting around. So, if Putin puts his stamp on it, everybody knows about it. But
Vladimir Putin, the Russian president.
Unfortunately, yes. But yeah, so I think this is something that, we're going to see. I think a lot of these partnerships, though, at times have broken up. I think initially JDS had a deal with Major Food, but they split for some reason. The partnership, which was allegedly was a partnership without a signed deal, but now Major Food is partnering with somebody else. I think they're looking in Edgewater now for a planned tower. So you got to be careful that sometimes these partnerships that look really good on paper with name-wise, brand names, sexy names, sometimes they fall through, as in this situation I just mentioned.
And I would just point out to the audience, keep in mind, if you buy into one of these condos that is branded, make sure you take a look at the condo declaration, because what you'll probably find is that there's a licensing agreement that requires you as an owner within this building to pay licensing fees to that particular brand. And once those fees or once the contract's entered into, you pretty much can't shake it unless you go to bankruptcy court, which was the precedent we experienced down here about 10 years ago or so, when a project called the Canyon Ranch, Miami Beach, ultimately ended up in bankruptcy. And the person who bought, or the group that bought the assets out of bankruptcy court, they asked the bankruptcy judge to go ahead and terminate the licensing agreement. So as a result, anybody who paid a premium to be in the former Canyon Ranch saw overnight that the branding was pulled, and now they just had a building called the Carillon but yet their purchase price didn't justify or didn't substantiate buying into Carillon, but they did the Canyon Ranch. So that's something to keep in mind. So with that, we'll go ahead. We'll take a break. Other side of the break, I'm going to ask the journalist to give us some words of advice as we go into the summer in the spring of 2023. This is Peter Zalewski of the Condo Vultures podcast. Before I started doing these podcasts, I was in the business of being a licensed real estate broker, a contributing columnist for the Miami Herald, as well as the Miami Real Deal, but also extra witness work in consulting. So if you are looking for an expert witness, or if you're looking for consulting services, a straight talk perspective as to what's going on in a particular marketplace, a building, or what happened previously, for whatever your situation is, whether you are an attorney, whether you are a institutional fund looking to invest, or whether you're a lender who's trying to come up with some sort of strategy and approach for your lending committee going forward, I would just like to be able to help you. To get a hold of me, please reach out to Peter@CondoVultures.com. That's Peter@CondoVultures.com, or give me a call to the office at 305-865-5859, 305-865-5859. Welcome back to the Miami Reporters Roundtable. I'm your host, Peter Zalewski. We went through 6 articles we discussed them. Now I'm going to ask the journalists to go ahead and provide some words of advice, if you will. We're in the second quarter of 2023. We have a changing economy. No one sort of knows what is going to go on as we go forward. We have a consumer price index number coming out very soon. The Fed will be meeting again in a month or so. So a lot of things are sort of uncertain. So what I want to do is I want to tap into some of the people who've been there before. They've seen it before. See if they can offer any kind of words of advice. Unfortunately, Jeff Ostrowski from Bankrate, he had a prior engagement. Therefore, he's not going to be able to provide his words of advice. So therefore, we're going to put more pressure on John Gruss and more pressure on John Fakler to sort of enlighten everybody. So with that, John, let's go to you. What would be your words of advice? We're recording this on the eve of the CPI number coming out, talking about what inflation is doing. Stock market's watching it. The finance world is watching it. What would be your words of advice, John?
Well, I wanted to add a little bit to the last story, which tackled the marketing of condo towers with luxury brands like Aston Martin and Bentley and Dolce & Gabbana. What is going to happen in 10 or 20 years when these buildings get old and, they start to show wear and tear? Do you think the Aston Martins and the Bentleys and the Dolce & Gabbanas are going to want to be associated with those buildings? I don't think so. And by then, I think the whole marketing of these buildings as luxury premium buildings, they'll be new and they'll be replaced. And so when you're looking to buy in these buildings, I think it's very good advice that you look at the condo documents, because not only will you be paying licensing fees, but how long is this is the term of the contract with these luxury brands? Because I can assure you that Dolce & Gabbana is not going to want to have a dilapidated old condo have their name associated with anything that is sort of old and starting to get run down, as all condos do in South Florida. I mean, just look at the condo towers that have been built in the last 20, 30 years. I mean, none of them are Aston Martins or Bentleys or Mercedes or BMW. They're not going to be associated with those luxury brands anymore, because those brands are not going to want anything to do with them. So I just think it's a bunch of smoke and mirrors, actually. And I just think that it's just another sales tactic, and you're just going to have to be extremely careful when buying one of these condos, and look at the contract with this luxury brand.
I think a great example of that was Donald Trump, the developer. He licensed out his name to a number of different buildings, and then when some of the stuff went on related to the election and his presidency, there were some people who were simply turned off by it. So there is a hazard associated with buying into a condominium that does have a brand. If the brand goes sideways, all of a sudden, what are you to do if you're an owner? So that's a very interesting point, John. Mr. Fakler, what about some words of advice from you?
Speaking of brand association, let's put this in reverse. I saw something interesting today. A journalist was introducing a story about Donald Trump arriving into the front row of UFC 287 at the Miami, newly named arena, which was once the AAA. Now, she didn't flub the name of it. I was waiting for her to do it. I'm already flubbing the name of it. So, Peter, you're going to have to help me to explain it to the audience. But, I sort of have a prediction on this. Even though she was able to say it well, this is a case where I wonder if they will renew this licensing agreement with this company just because of the name. It's so hard to say. It's so hard for people to relate to. It may be a short-term, unless there's a longer-term deal in place.
I think it's a decade.
I would. Oh, it's a decade.
I think it's a decade.
Okay, so that's. I guess my prediction is moot, but I just thought it was an interesting comparison because that it's such an unusual. It didn't affect UFC was sold out. I mean, there was Donald Trump waving everybody from the first row, but I think in the future, I think brands. Stadiums are going to be very cognizant of the names of these new licensing partners to make sure that at least people can say what they are. Because
So the AAA is what it was referred to as known as the American Airlines Arena. That's where the Miami Heat played. American Airlines had its banner and its branding on it since the arena opened back in 2000. Then the term was coming to an end. Miami-Dade County reached out. And they got a sponsor in the form of FTX. Unfortunately for FTX, which was a Bitcoin in a crypto exchange, they got jammed up. They got accused of fraud. They ended up filing BK. The founder was extradited from the Bahamas to the United States. Is facing all sorts of charges related to fraud. And Miami-Dade County, which owns the arena, had to come up with a new sponsor. They took it out to market. They got back some variety of different names and ultimately decided to go with a software company that I don't know how to say either. So, Jean, you're the only one who's familiar with this company, but I guess this company has a checkered past in that they were part of a big hack that occurred. They were the victim of a hack that occurred in recent years. So, Jean, can you fill in that last part of the name sponsor of the arena where the Miami Heat plays?
Yeah, Kaseya. Yeah, Kaseya, and they are a software company. They provide services to small and medium sized businesses, they unfortunately were the victims of a hack of a very significant hack just about a year and a half ago. They've recovered from that, and because they've been able to pony up quite a bit of money, I think, for the sponsorship.
Well, good luck to them. Good luck to them with that name, because people are going to struggle with it. So,
at least it's a hometown. At least it's a hometown company. I mean, I've got to say that headquartered in Miami, publicly traded, I think, and a lot of people work here and benefit, from the jobs here, and so I think that's probably appropriate, rather than an out-of-town crypto exchange based in
but I wonder, Burger King is based in Miami. So is Popeyes. So is Lennar, one of the largest big home builders in the country. I wonder why all those brands that already have recognition, maybe they did it because they have recognition, why they gave it a miss. And we ended up with Kaseya. Is that right, John? Kaseya?
Yeah, Kaseya needs branding. It needs to get its name out there. It needs, it's not a household name like Burger King. So it needs some recognition. So having their name out there may help them. I don't understand the economics of these kinds of sponsorships. They really don't make much sense to me. But there's people that believe in sponsorships as a great branding opportunity. I mean, I'm not a branding expert, but if it works for them,
fantastic,
that's great.
fantastic. And then in terms of my words of advice, I would actually advise planning and zoning boards around South Florida to take a look at sort of their books, take a look at what their overview is, and try to figure out what can they do to better the community. And one thing I would lobby for is taking some of this vacant retail space and these lower floors in some of these condo buildings. Many condo buildings, anybody doesn't know it, first 8 floors are going to be parking, and then there'll be some townhouses on the front. Maybe they'll sprinkle in some offices, and then on the ground floor, you're going to have retail space. A lot of these retail spaces are struggling. building I'm located in, which is the Marina Blue, right across from the Kaseya Arena, the former AAA, former American Airlines Arena. Some of the commercial space just ran into foreclosure. They're not able to basically substantiate and support, the prices or the amount of money they paid associated with the financing for that particular space. So my recommendation is, why not figure out a way to allow families who are living in these towers in neighboring buildings to simply take the elevator down, walk your kid across the street, and put them in a classroom that's located in former retail space. Now, granted, there's security issues. There's going to be other issues associated with recess, but there has to be a way to utilize the space. And in terms of tapping into existing infrastructure, rather than going and building a whole new school, why can't you just create classrooms or certain areas at the bottom of some of these buildings? And a lot of the space is vacant. I mean, right down the street from my office, where you have the Zaha Hadid building, the 1000 Museum, Museum Park building, you have all of this retail space where nobody's using it. And the building's been open for a couple of years now. So that'd be my words of advice. Don't build new schools. Utilize what you have already. And what it'll do is it'll work towards creating an urban area. So those would be my words of advice. Let me go ahead and wrap up this podcast. I want to thank John Gruss. John was a journalist for 25 years. Right now, he's a public relations marketing firm called Gruss Communications. You want to get a hold of him, go to his website, GrussPR.com. That's GRUSSPR.com. Also want to thank Jeff Ostrowski. Jeff had to leave us early. He is a mortgage writer over at Bankrate. And if you want to get a hold of Jeff, you can look him up on Twitter. His Twitter handle is going to be, and I got to refer to my notes, it's going to be Bio561. Bio561 at BIO561. And I also want to thank John Fakler. John wrote about white collar crime. He wrote about business. He also did restaurant reviews over the South Florida Business Journal. Right now he does public relations and marketing. If anyone wants to get a hold of John, they can reach him at Fakler@consultant.com, Fakler at consultantsingular.com. And I'm Peter Zalewski. Thank you for tuning in. Let me remind you got any comments, any questions, please send us an email at inquiry@CondoVultures.com, INQUIRY@CondoVultures.com. And don't forget, you can actually watch this podcast, go to any platform that provides for video, such as Spotify. And if you want to look us up on YouTube, the handle is CondoVulturesTV. Until next time, take care of yourself. Ciao, ciao.
Don't buy a South Florida condo, discounted or distressed, before taking a Condo Vultures correction tour. CondoVultures.com offers weekly bus and walking tours that focus on educating buyers on the how-tos of identifying discounted condos, analyzing the opportunities, and purchasing units. Every tour attendee receives a list of all condo projects in a particular market, a market assessment handout, and unmatched expert analysis. For more information on the condo correction tours, please visit CondoVultures.eventbrite.com.